I want you to picture something, just for a second. Reach into your pocket, or maybe check the cup holder in your car. Find a coin, a single 1 pound coin.
Mm-hmm.
It's a pretty trivial object, right? You might use it for a shopping cart at the supermarket. Maybe you get a piece of gum. It's basically loose change.
It's kind of money you drop on the pavement and, maybe not even bother to bend over and pick up.
Exactly. Now take that one coin, and I want you to imagine using it to buy a bank.
A piggy bank.
Not a piggy bank, and not some, fintech startup in a garage. I mean, one of the oldest, most prestigious, most aristocratic financial institutions on the entire planet.
It sounds like the setup to a really bad joke. A man walks into a bank with a pound coin. But as we're going to find out, financial history has a much darker sense of humor than fiction.
We are talking, of course, about the spectacular, the almost unbelievable, and frankly humiliating collapse of Barings Bank. In 1995, this institution, which had stood proud for 264 years, was sold
To the Dutch bank, ING.
for the nominal sum of 1 pound. One.
To really get your head around the sheer gravity of that 1 pound price tag,
Yeah.
you have to understand the history that was being sold for scrap metal.
Right.
This isn't a dot-com bubble burst. This is the bank that financed the Napoleonic Wars. This is the bank that effectively paid for the Louisiana Purchase, doubling the size of the United States.
It was founded in 1762. Just think about that for a second. That's before America was even a country. This bank survived the American Revolution, the French Revolution, World War I, the Great Depression, World War II. It was a titan. It was the financial bedrock of the British Empire.
And yet, it wasn't a world war that killed it. It wasn't a pandemic or a revolution. It collapsed. It completely disintegrated in a matter of weeks because of one guy.
One guy.
A 28-year-old trader in a striped jacket, sitting at a computer terminal in Singapore, hiding his mistakes.
It's just the ultimate case study, isn't it? The tension between centuries of tradition and the raw, brutal speed of modernity.
Absolutely. On one hand, you've got gentlemanly capitalism, titles, tea at 4 o'clock. On the other, you have the lightning-fast, high-risk, testosterone-fueled world of modern derivatives.
And somewhere in the middle of all that, a catastrophic failure of risk management.
And a failure of imagination. I think that's the real key. The people in charge in London, the ones running the bank, they just couldn't imagine that someone like Leeson could destroy something as permanent, as solid as Barings.
So that's our mission for this deep dive. We're going to trace this whole arc from being a global superpower to just total ruin. We need to understand how Barings literally shaped the world map, and then how a complete lack of internal controls let one man burn the whole thing to the ground.
And what we're going to find is that the seeds of its destruction, they were planted much, much earlier than anyone realized at the time. It's a story about hubris, about greed, and, what happens when you let the fox design the security system for the henhouse.
Okay, let's start at the beginning. We have to understand what was lost. We are setting the dial way back to 1762, London.
The 7 Years' War is just winding down. The Industrial Revolution is starting to bubble up. And a man named Francis Baring establishes a company. Now, he was British-born, but his family was originally German, from Bremen. Merchants.
And it didn't start as a bank, right? They weren't immediately building vaults and issuing bonds.
Oh, not at all. That's a very modern idea.
Yeah.
In 1762, it was the John and Francis Baring Company, and they were, for all intents and purposes, import-export merchants.
What were they trading?
They started with wool. Good, solid English wool. They were operating out of offices just off Cheapside in London. It was a very physical business. You buy the wool, you sell the dye, you ship the finished cloth. But Francis Baring he was incredibly ambitious. They gradually moved from just wool into all sorts of other commodities.
And this is where we have to pause and address the darker side of that business right from the start. You can't really tell the story of 18th century British wealth without talking about where some of that capital came from.
You can't.
Yeah.
The sources are very clear on this. As they expanded into global trade, Barings provided financial services for the slave trade. It's a grim, inescapable reality of that world. The slave trade significantly enriched the Baring family and their business. That capital allowed them to expand, to take on bigger deals, to build their prestige. You really can't separate the accumulation of that early wealth from the mechanisms of the Atlantic slave trade. It was the engine of so much colonial wealth, and Barings was right there in the gearbox.
It's a very sobering context for the massive power we're about to see them use. Because as they moved from just trading goods to financing the trade of goods, they became what we now call a merchant bank.
And to do that on a global scale, You need powerful friends. Their most important partner was a firm called Hope & Co. out of Amsterdam.
Right, because Amsterdam was the financial center back then, not London.
Not yet, no. Amsterdam was the heavyweight champion of the world. Hope & Co. was the most powerful merchant bank there, deeply involved with the Dutch East India Company. By partnering with them, Barings tapped into this huge network of European capital.
And that network,
Yeah.
that partnership, allowed them to pull off what is, I think, inarguably the biggest real estate deal in human history.
The Louisiana Purchase. 1802, 1803. This is the moment where Barings goes from being just another successful London firm to being a genuine player on the world stage. This is where they become a superpower.
I think most of us, we remember the basics from history class. Thomas Jefferson bought a huge piece of land from France, doubled the size of the U.S. It sounds so simple.
It sounds neat and tidy. The reality, when you dig into the mechanics of the deal, is incredibly messy. It's a geopolitical thriller.
So set the scene for us.
Okay, so you've got Napoleon Bonaparte in charge of France. He's looking at this massive territory in North America, Louisiana, and he's a pragmatist. He knows he can't defend it. The British Royal Navy, it controls the seas. He also knows he's about to go to war with Britain again. And he needs money. He needs cash for cannons, for ships, for paying soldiers. That land in America is just a liability waiting to be captured.
So it's an asset he needs to liquidate fast.
Right. And on the other side of the Atlantic, you have the United States. President Jefferson is terrified that Napoleon is going to block access to New Orleans and control the Mississippi River.
Which would basically strangle the entire American economy west of the Appalachians.
It would cripple them. So he desperately wants to buy it.
The price tag was $15 million, which even then, for that much land, sounds like a steal.
It is the bargain of the millennium. It works out as something like 4 cents an acre. But here's the problem, and this is why you need a bank like Barings. The United States government did not have $15 million in gold just sitting in a vault.
And even if they did,
Napoleon didn't want a check drawn on a U.S. bank. He didn't want American IOUs. He wanted gold in Paris yesterday.
So you have a buyer with good credit, a seller with a desirable asset, but no hard currency to actually make the deal happen. A classic liquidity crisis.
Enter Barings. This is where the whole sixth great power reputation begins. Francis Baring and his partners at Hope & Co. step into the middle. They bridge the gap between these two empires.
How did they structure it?
It was ingenious, really. The U.S. government issued bonds, basically government IOUs, to Barings. Barings then bought those bonds.
But not for face value, I'm guessing.
Oh, absolutely not. This is where the profit is. They bought the bonds at a very steep discount. The sources say they paid $87.50 for every $100 of face value.
So that 12.5% haircut, that's their fee, their risk premium.
Exactly. Barings is essentially saying, we'll give Napoleon the cash you need right now, and we will take on the risk of holding these American bonds and collecting the interest over the next 15 years. They were placing a massive bet on the future of the United States.
Which in 1803 was not a sure thing at all. The U.S. was basically a startup country.
It was a risky venture. But here is the craziest part of the whole deal. The part that really shows you the kind of power Barings wielded.
Go on.
Britain and France were on the very brink of war. In fact, war did break out while this whole transaction was settling.
Wait a minute. So you have a British bank, Barings, sending gold to Napoleon, which Napoleon is then immediately using to build ships and forge cannons to attack Britain.
Precisely.
That sounds, isn't that treason? Here's the money to invade us, Napoleon. Good luck.
Laughs. If you or I did that today, we'd be in a very dark room for a very long time. But back then, high finance operated on a different plane, almost above the nation state.
The government must have known.
Oh, they knew. The British Prime Minister at the time, Henry Addington, was fully aware. But his reasoning was, and I'm paraphrasing here, it is arguably better that the money should be provided by a British merchant than by anyone else.
Wow. So the logic is, well, Napoleon's going to get the money one way or another, so a British bank might as well make the profit on the deal.
That's it. It was profit over patriotism. Or maybe long-term commercial pragmatism. Francis Baring and the British government believed that an expanding United States would ultimately be good for British trade. They were playing a much longer game.
And what about the actual logistics? This isn't a wire transfer. How do you move that kind of value?
You put your own people on boats. Francis Baring's son, Alexander Baring, personally traveled to Paris to negotiate with the French Treasury. Then he sailed to the United States to physically pick up the bonds and bring them back to Europe.
That's incredible. the bank's own partner is sailing across the Atlantic, dodging storms and potentially Royal Navy patrols, carrying the paperwork that will double the size of America.
It just shows their power. By 1818, after the wars were over, a French minister, the Duc de Richelieu, famously declared that there were 6 great powers in Europe: England, France, Prussia, Austria, Russia, and Bering Brothers.
The sixth great power. That's not just a nickname, that's a geopolitical statement. They're ranked alongside empires.
And they acted like one. They weren't just observing history, they were actively financing it. During the War of 1812, Barings was helping to finance the United States government.
Again, with the irony, the War of 1812 was the U.S. versus Britain. The British burned down the White House, and a British bank is funding the other side.
Capital has no nationality, as the old saying goes. By 1843, they were the exclusive agent to the U.S. government in Europe. They were just deeply, deeply embedded in America's growth. They financed the railroads that built the West.
There's a specific example in the notes about that with the Canadian Pacific Railway.
Yes, Barings was instrumental in financing the completion of that railway, which, is what really created the nation of Canada as a unified coast-to-coast entity.
And there's even a town named after one of them.
There is, Revelstoke in British Columbia. It was named after the senior partner of the bank at the time, Edward Baring, who was the first Baron Revelstoke. They also financed huge American railways like the Atchison, Topeka, and Santa Fe.
So they're literally building the infrastructure of the New World. But it wasn't all triumphs. Closer to home, they had a more controversial chapter.
The Irish famine.
Yes.
This is a difficult part of their story, and it really shows the flip side of that aristocratic, detached worldview. In 1845, the potato crop in Ireland failed. It was an absolute humanitarian catastrophe.
And the British government stepped in.
The Prime Minister, Sir Robert Peel, appointed Barings to be the government's agent to supply Indian corn maize to Ireland for famine relief.
And did they do it?
They did, for a time. Between late 1845 and the summer of 1846, they acted as the purchasing agent. But then, in 1846, the government changed its policy in Barings. They just walked away.
They walked away in the middle of a famine. Why?
It was about reputation. They stated officially that they would refuse any future commissions in famine relief to avoid, and this is a direct quote, the blame this could so easily entail.
That is unbelievably cold. We don't want the bad PR if this goes wrong, so we're out.
It's a stark look into the mindset of the institution. They were a business first, last, and always. But despite these controversies, their cultural dominance in the 19th century was just absolute.
This is where we get the Jules Verne reference.
Yes. Around the world in 80 days. When Phileas Fogg makes his famous bet that he can circumnavigate the globe in 80 days, he guarantees it with a check for £20,000. And that check is drawn on
Barings Bank.
Exactly. Verne didn't even have to explain it. He used Barings as shorthand for money that was as solid as the ground beneath your feet. If your money was with Barings, it was safe, period.
And just to complete the picture of their establishment credentials, there's even a link to the royal family.
There is. Ned Baring, the first Baron Revelstoke, the man Revelstoke is named after. His daughter Margaret was the great-grandmother of Diana, Princess of Wales.
So the bank's bloodline is directly intertwined with the future King of England.
Yes. It all paints this picture of utter invincibility, a power unto themselves, connected to royalty, financing empires. What could possibly go wrong?
Well, as is so often the case, arrogance, hubris. And the first major crack in that invincible armor appeared in 1890.
The Panic of 1890, also known as the Baring Crisis.
It sounds like a prequel to what happened in 1995.
It's frighteningly similar. It's almost a perfect dress rehearsal. In the late 1880s, Barings got a bit too hungry for high returns. They started underwriting a huge amount of debt in South America, particularly Argentina and Uruguay.
Argentina seems to be a recurring character in the history of financial crises.
It is indeed. There was a massive land boom going on in Argentina. Barings was heavily exposed. They were backing bonds for waterworks, drainage systems, new railways.
And then the music stopped.
The bubble burst. Political unrest at Buenos Aires. There was a revolution. The president resigned. Argentina was on the verge of defaulting on all its debt.
And Barings was holding the bag.
They were holding the entire bag. They had guaranteed the bonds, but they didn't have the liquid reserves to actually make good on those guarantees. They were, for all intents and purposes, insolvent.
But they didn't collapse. Why not? What was different in 1890?
In 1890, Barings was considered too big to fail.
Ah, that phrase.
The governor of the Bank of England at the time, a man named William Lidderdale, knew that if Barings went under, it could trigger a global financial meltdown. It would destroy the reputation of the City of London. So he organized a bailout.
Who paid for it?
A whole consortium of other banks, funnily enough, headed by the Guinness family firm. The Bank of England guaranteed the debts, and everyone else chipped in to keep Barings afloat.
So they survived, but they must have been wounded.
Deeply wounded. It came at a massive cost. The bank was forced to restructure from a private partnership into a public limited liability company. The Baring family themselves lost huge personal fortunes because their own wealth was pledged to the bank, and they lost their top dog status to rivals like the Rothschilds. It was a humiliating near-death experience.
And I have to imagine that kind of trauma changes the culture of a place.
Completely.
Yeah.
And this is so important for understanding what happened a century later. For the next 100 years, Barings became incredibly conservative. We call it the period of caution. They were just gun-shy. They became the boring bank.
Which, ironically, probably saved them later on.
It absolutely saved them during the Great Depression.
Right.
Well, other banks in the 1920s were lending huge sums to Germany to help it recover from World War I. Barings refused. They remember the sting of Argentina.
Yeah.
So when the crash of '29 came and all those German loans went bad, Barings was relatively safe.
Okay, so let's fast forward to the 1980s and early 90s. We have this bank that is smaller, more cautious, but still incredibly prestigious. It's seen as blue-blooded, safe, maybe a bit dusty. But the world of finance is exploding.
Yes, the Big Bang of deregulation in London in 1986 changed absolutely everything. Suddenly, the old gentleman's club was over. The markets were thrown open. Aggressive American banks were flooding in. Everything was getting faster, riskier, more lucrative.
And Barings looked at this new world and felt left out.
They had a serious case of what you might call prestige anxiety. They were the old aristocrats watching the loud, rich new money have all the fun. They wanted to get back in the game. They wanted to be cool again.
So they tried to modernize?
They did. They started buying up stockbrokers and other firms to build a modern securities business, to sit alongside their old-fashioned banking arm. They were trying to catch up.
And that desire to catch up, that brings us to Singapore and to the man of the hour, Nicholas Leeson.
Nick Leeson. You couldn't invent a character more different from the traditional Barings man. He wasn't an aristocrat. He didn't go to Eton or Oxford. He was a working-class lad from Watford. His dad was a plasterer.
A borrow boy, as they used to call them in the city.
Exactly. But he was sharp, he was ambitious, he had a certain charm. In this new, aggressive trading environment, that was seen as an asset. So in 1992, Barings sent him out to Singapore to run their new derivatives trading operation on the SUMEX, the Singapore International Monetary Exchange.
Now, this is really important. Before we get into the fraud, we have to understand what he was supposed to be doing. Because on paper, his job was meant to be boring, low risk.
Oh, absolutely. He wasn't sent there to be a cowboy. In theory, he was there to run a money-printing machine that was perfectly safe. He was tasked with arbitrage.
Okay, let's break down arbitrage for everyone listening. Give me the simple, real-world version.
Okay. Imagine you're at a huge flea market. You see a vintage watch at one stall, and the price is $100.
Right.
You know for a fact that at a stall on the complete other side of the market, the exact same watch is selling for $105. If you can run fast enough, you buy for $100, spread across the market, and sell for $105. I've just made $5 risk-free.
The key is you have to lock in both prices at the same time before they change.
Speed and execution. That's all it is. Leeson was trading Nikkei 225 futures, basically, contracts betting on the future value of the Japanese stock market. These contracts were traded in two different places, on the Osaka Exchange in Japan and on the CEMEX in Singapore.
So it's like the watch being sold in two different stalls. The price might be slightly different for a split second.
Precisely. Because of tiny time lags or market inefficiencies, the price would briefly diverge. Leeson's entire job was to spot that tiny difference, buy the cheap one in Osaka, and simultaneously sell the expensive one in Singapore.
And because he's doing this with millions and millions of the bank's pounds, those tiny little pennies on each trade add up to a huge, steady profit.
It's a volume game. It's supposed to be like shelling peas. It's not gambling. It's just exploiting a mathematical certainty. If you do it right, you literally cannot lose money because your positions are hedged. You've bought and sold at the same time.
It sounds perfect. Save money. So how does a guy doing something so boring manage to destroy a 200-year-old bank?
Because of a fatal, unforgivable flaw in how Barings set up their Singapore office. And this is the single most critical point in the entire story. In any properly run bank, you have the front office, the traders, the people making the bets, and you have the back office, or settlements. They're the accountants, the people who check the records, confirm the trades, and make sure the money actually goes where it's supposed to go.
A separation of powers.
It is the absolute golden rule of banking. The person writing the checks cannot also be the person balancing the checkbook. The poacher cannot be the gamekeeper.
But in Singapore?
In Singapore, Barings was trying to save a bit of money on headcount. They thought it was a small, simple operation. So they allowed Leeson to hold both jobs. He was the general manager of trading, and he was the head of settlement operations.
Wait. So he was checking his own work.
He was marking his own homework. He was the student and the teacher. It meant he could operate with zero effective supervision from London. He could make a trade, and if it went wrong, he could just bury it because he was in charge of the burial ground.
That's insane. And that brings us to the infamous secret account. The 8888888 account.
The 5/8 account. In many Asian cultures, the number 8 is considered lucky. It sounds like the word for wealth or prosper. For Barings, it was the number of their doom.
What was this account originally for?
It was set up as a standard error account. Every trading desk has one. If a trader makes a small mistake, buys when they meant to sell, a typo, they put the erroneous trade in the error account to be sorted out later. It's for small administrative screw-ups.
But Leeson used it as a secret dumping ground.
It started small. Leeson's story is that it all began when one of his junior traders made a mistake that lost about 20,000 pounds. To protect her, to be the good guy boss, he hid the loss in account 888888. His plan was, I'll just make a few good trades next week and earn it back. No one will ever know.
But you can't make back 20,000 pounds quickly with safe arbitrage. Arbitrage makes pennies.
Exactly. To make that kind of money back quickly, you have to gamble. And that's the moment he crossed the line. He stopped doing safe arbitrage and started taking naked positions. He wasn't hedging anymore. He was just making massive one-way bets on the future direction of the Japanese market.
He was just guessing.
He was guessing. And when he guessed wrong and lost money, he hid the loss in 8888. When he guessed right, he'd report the profit to London. Now, here's the technical trick he used. He was able to get into the computer system and alter the reporting so that the London office would never even see a report for that specific account. He essentially made it invisible to his bosses.
So as far as London knew, he was this trading genius, this whiz kid making the millions in steady, safe profits. They see all the wins.
But they're completely blind to the ever-growing mountain of losses in the secret account. He was hemorrhaging cash. By December of 1994, the secret losses in account 808888 had ballooned to 200 million pounds.
200 million.
But, and this is the scale of the deception, he officially reported a profit of 102 million pounds for the year.
So there's a 300 million pound gap between what his bosses thought was happening and reality.
And here's the real tragedy. If they had caught him then, in December 1994, the bank could have survived. They had about 350 million pounds in capital. Taking a 200 million pound loss would have been catastrophic. People would have been fired. It would have been a huge scandal. But the bank itself would have still existed.
But they didn't catch him. And the bets he was making were getting bigger and bigger. You mentioned he was using a specific, very dangerous strategy.
Yes, a short straddle. This is crucial to understanding how the losses exploded so quickly.
Explain it to me like I'm 5.
Okay. A short straddle is a bet on boredom. You are betting that the market will stay flat, it won't go up very much, and it won't go down very much. You're betting on stability.
And how do you make money from that?
You effectively become an insurance salesman. You sell 2 types of options contracts to other traders, one that pays out if the market goes up a lot, and one that pays out if it goes down a lot. You collect the cash, the premium, from selling this insurance.
So Leeson is the insurance company. He takes all this cash up front and says, don't worry, folks, nothing exciting is going to happen.
Exactly. And as long as the market stays calm and quiet, he just keeps all the premium money. It looks like free cash. It's a strategy often described as picking up pennies in front of a steamroller.
You can pick up a lot of pennies.
But if that steamroller ever actually hits you, you're slattened. The risk is unlimited. If the market makes a huge move in either direction, up or down, you lose a fortune.
And Leeson had sold tens of thousands of these contracts. He had bet the entire bank that the Japanese stock market would remain quiet.
And then, on January 17th, 1995, the universe decided to call his bluff.
The catalyst. The Black Swan event. The Great Hanshin earthquake hits the city of Kobe in Japan. A devastating 7.3 magnitude quake. Buildings collapse, highways fall over, thousands of people are killed.
And obviously, a disaster of that scale is not good for the Japanese economy. The steamrollers started to move. It moved very, very fast. The Nikkei stock index plummeted. Market volatility went through the roof. Leeson's short straddle strategy was instantly massively underwater. All those insurance policies he had sold were suddenly being cashed in at once.
Now, a normal, rational trader in that position would call their boss, confess everything, and cut their losses immediately, take the pain.
But Leeson wasn't rational anymore. He was in a deep, dark hole, and his only thought was to dig deeper. He doubled down. He made a new, even bigger bet. He convinced himself the market would rebound quickly. He thought the Japanese government will step in, there will be a construction boom to rebuild, the market will bounce back.
So what did he do?
He started buying Nikkei futures contracts. Not for arbitrage, just pure, naked gambling. He started buying thousands and thousands of them, trying to single-handedly prop up the market. At one point, Nick Leeson personally accounted for almost half of all the open Nikkei futures contracts on the entire Singapore exchange.
He was trying to fight the entire global market with Barings money.
He was. And to keep those massive positions open, he needed a staggering amount of cash every single day to pay what's called margin to the exchange.
So where did he get the money?
He asked London for it. And this is the part of the story that just defies belief. He would just call his bosses in London and invent a reason. I need 50 million pounds to fund a new trade for a big client. Or I need 20 million to cover a short-term timing difference.
And London just sent it. No questions asked.
They sent it. They wired hundreds and hundreds of millions of pounds to him in Singapore.
But why? Why didn't they ask to see the client's name? Why didn't they check the paperwork?
A combination of incompetence and confirmation bias. They thought Leeson was their golden goose. In their minds, if he was asking for huge sums of money, it must be because he was doing huge profitable trades. They interpreted the massive cash drain as a sign of incredible success.
It's like a parent who keeps giving their kid money for college books because they can't bear to believe the kid is actually gambling it all away.
It's a perfect analogy.
Mm-hmm.
And you have to remember the culture clash. The senior managers in London were these old-school aristocratic bankers. They didn't really understand the complex mathematics of derivatives. They were intimidated by it. They didn't want to ask a stupid question and look foolish in front of this young whiz kid from Watford, so they just signed the checks.
So the losses are just spiraling out of control. The market keeps falling. Leeson keeps buying. When did the music finally stop?
Thursday, February 23rd, 1995. Leeson finally realized the game was up. The bank's auditors were in the Singapore office, and they were finally asking specific, pointed questions about the 88,888 account that he couldn't deflect. The cash demands from the exchange were now so colossal that London had finally said, "We literally have no more cash to send you."
So what does he do?
He runs. He leaves a note on his desk that says, "I'm sorry," walks out of the office, goes home, tells his wife Lisa they have to leave immediately. She had no idea about any of the fraud, and they drive to the airport.
He just flees the country.
Gets on a plane to Kuala Lumpur, Malaysia. He checks into the Regent Hotel and just waits. He spends the weekend watching the news, waiting for the world to find out what he'd done. He then sends a fax from the hotel, a confession note, to Peter Baring, the chairman of the bank in London.
Can you even imagine being Peter Baring at that moment? You're the head of this ancient, invincible institution, and you get a fax that says, "So sorry, I seem to have lost the bank."
It was pure chaos in London. The auditors in Singapore finally forced their way into the computer system and opened up the 8888 account file. The numbers were just horrifying. The final tally of the losses was 827 million pounds.
827 million.
About 1.3 billion US dollars at the time.
And how did that compare to the bank's total capital?
It was more than double the bank's entire available trading capital. He had lost every penny the bank owned and then lost it all over again. The bank wasn't just broke, it was a black hole of debt.
Utter annihilation.
The Bank of England tried to orchestrate a rescue. Just like they did in 1890, the governor got all the heads of the other big banks together for a secret weekend meeting. They tried to put together a bailout package. But this time, the hole was just too deep. And crucially, the risk was unquantifiable. No one knew for sure if there were even more losses hidden somewhere. No one was willing to touch it.
The too big to fail principle didn't apply this time.
Not this time. So on Sunday, February 26, 1995, the Bank of England announced that Barings Bank was insolvent. Done. Finished. Administrators were called in.
And all the employees around the world.
They showed up for work on Monday morning in London, New York, Tokyo, Hong Kong to find the doors locked and a notice on the door. Jobs gone. And for many senior people, their life savings gone because their bonuses were paid in Barings stock, which was now worthless.
Just a brutal, brutal end. So the bank is dead, but the brand name, the client lists, that must have been worth something.
It was. The Dutch bank ING saw an opportunity. They were interested in the asset management and corporate finance parts of the business, so they swooped in and bought the entire bank for the sum of £1.
There's that coin again?
Of course, the real price was that ING also had to assume all of Barings' massive liabilities. But the symbolic headline price to buy 233 years of British history was one single pound coin.
And Nick Leeson, the man who did all this, he's hiding out in a hotel in Malaysia.
He didn't stay hidden for long. He tried to fly back to Europe, hoping he'd get a more lenient sentence in a British court, but he was arrested during a layover in Frankfurt, Germany on March 2nd.
And extradited back to Singapore.
Yes. And Singapore has a very, very tough reputation for financial crime. He was sentenced to 6.5 years in the infamous Changi prison.
And did he serve the full term?
He served about 4 years. He was released early in 1999 after being diagnosed with colon cancer in prison, which he survived.
And then, in this bizarre twist that only seems to happen in the modern world, he became a kind of celebrity.
He absolutely did. It's wild. He wrote a book in prison, Rogue Trader, which was then turned into a Hollywood film starring Ewan McGregor. He became a fixture on the after-dinner speaking circuit, getting paid to tell his story. He was even briefly the CEO of an Irish football club.
It's just incredible. And there's a detail in the notes that perfectly captures how strange this whole saga became. In 2007, his old trading jacket, the one he wore on the floor of the Cimex,
The blue and yellow striped one.
it was sold on eBay for £21,000.
People love a villain, I suppose, or at least a souvenir from a famous disaster. It's a relic from one of the most spectacular financial crashes in history.
We should mention, though, that one small piece of the Baring legacy did actually survive the crash.
That's right, the Baring Foundation. It's a charitable foundation that the family had established back in 1969. And because its assets were legally ring-fenced and separate from the bank, it was untouched by the collapse. It's still around today, giving out millions in grants.
So some of that historic wealth, which, as we discussed, has a complex history.
A very complex history, tracing all the way back to wool and the slave trade and empire. Some of it is now being used for good causes. A small silver lining, I suppose.
A very small one. So let's step back. We've gone from financing the Louisiana Purchase to a guy in his 20s hiding losses in a computer account named after lucky numbers. What's the big takeaway here?
For me, it's the fragility of it all. We think of these huge ancient institutions as being permanent fixtures of the world. Barings survived Napoleon, it survived 2 world wars and the Great Depression. It had traditions and connections that seemed unbreakable.
But it couldn't survive one unsupervised employee with a computer.
Exactly. Technology is a force multiplier. In the 1800s, if a partner made a bad bet in Argentina, it took weeks for the ship to sail back to London with the bad news. You had time to react.
Yeah.
In 1995, and even more so today, you could lose $1 billion in the blink of an eye.
It really raises a pretty provocative question for all of us now, doesn't it? We like to think our modern financial system is safer. We have better regulations, we have compliance officers, we have AI monitoring trades. We've learned the lesson of Barings. But have we, really?
That is the multi-trillion-dollar question. Because if the person who is supposed to be watching the system is also the person who can manipulate the system, history would suggest no institution is ever truly safe. The tools get faster, the money gets bigger. The basic human psychology, the greed, the fear, the desperate need to hide a mistake, that hasn't changed one bit since 1762.
Does the speed of information today just mean that a 200-year-old institution can be destroyed even faster than Barings was?
I think the answer is almost certainly yes. In a digital world, trust and capital can evaporate in seconds. Barings was really the first great casualty of the digital trading age, and I very much doubt it will be the last.
On that slightly terrifying note, I think I'm going to go check my own bank balance, just to be on the safe side.
Probably not a bad idea.
Thanks for listening to this deep dive. We'll see you next time.